Welcome to today's Explainer. Today, we are peering right under the hood of financial markets to look at the hidden mechanics of market microstructure. Whether you're a seasoned trader or just someone who's kind of curious about how global finance actually ticks, you've probably noticed something. The very second you execute a trade, you immediately lose a tiny fraction of a percent. Well, why does that happen? It's all because of a fundamental concept known as the bid-ask spread. So we're going to decode exactly what the spread is, how it governs market liquidity, and most importantly, how understanding it can absolutely make you a sharper decision maker. Let's dive in. Okay, here's a quick look at our roadmap for today. We'll start with bids, asks, and order books, then move into a really fun concept called the marriage matching analogy. After that, we'll go inside the bid-ask spread, tackle execution, slippage, and regret, examine the role of market makers, and wrap up with protecting your trades. All right, part one, bids, asks, and order books. To really grasp any market, you have to understand its most basic building blocks. Every single trade out there needs a buyer, a seller, and crucially, a gap between them. So let's look at the demand side first. The bid is, quite simply, the highest price a buyer is currently willing to pay for an asset. If you're looking to sell a stock right now, the bid is the exact price you're going to get. It represents the active demand in the market at any given millisecond. Now, on the flip side, we have the ask, which is sometimes called the offer. This represents the supply side of things. The ask is the lowest price at which a seller is willing to actually part with their asset. So if you log into your brokerage to buy a stock right this second, you are going to be paying the ask price. And that distance between those two prices, the bid and the ask, is what we call the spread. Think of it as market friction. Now, if the spread were zero, you'd have a completely frictionless asset, which, let's be honest, is practically a myth in the real world. Let's anchor these definitions with some real-world data so it really clicks. Take two major currency pairs, for example. For the euro to US dollar pair, the bid might be 1.5760 and the ask 1.5763. See that difference? It's exactly 3 pips. And that exact same 3 pip spread might exist for the US dollar to Japanese yen pair right below it. This spread acts as an immediate toll. It's the undeniable cost of entering or exiting a trade, and it's a direct measure of market liquidity. Tighter spreads mean high liquidity and lower costs for you, while wider spreads mean lower liquidity and much higher transaction costs. Moving right along to section 2, the marriage matching analogy. Okay, we're going to pivot a bit here to make this highly mathematical concept of market friction visceral and incredibly human. Consider this. What do financial markets have in common with finding a spouse? I know, it sounds like a joke, right? But a recent academic paper beautifully models human mate selection, not as a simple negotiation, but as a complex limit order book system characterized by rigid bid-ask spreads. Here is how it works. In dating, everyone has an internal ask. This is your unconditional max, or the absolutely ideal partner you believe you deserve. But then there's the market bid. That's your reachable max, which is the best available suitor currently participating in the market. The distance between your ideal expectation and the reality of the market is a structural, psychological gap. You guys, it's a literal bid-ask spread. And just like in illiquid financial markets, this gap is notoriously stubborn. Simply throwing a little extra money, or in dating terms, compensation, at a bad match rarely closes that deeply ingrained psychological gap. What's genuinely fascinating here is how perfectly human behavior mathematically maps directly to an order book. Think about it. When you hold out for your absolute ideal partner, you're essentially placing a passive limit order. If you experience rejection, well, that is simply a wide spread where the market fails to clear. And if you decide that your age or social pressure means you just can't wait anymore and you decide to settle for the best available option right now, that is the exact equivalent of executing a market order to bridge the gap. You're taking whatever immediate liquidity is available. Section 3. Inside the bid-ask spread. Let's take that powerful human analogy and transition back into the strict financial mechanics that actually dictate the size of this gap. I want you to mentally map out the spread's DNA into 3 primary measurable costs. First step, order processing costs. This is just the basic cost of keeping the exchange's lights on, the servers running, handling the paperwork. Second, inventory holding costs. Whoever provides the asset takes on serious risks that the price might drop while they're holding it, so they charge a premium for bearing that risk. And third, adverse selection costs. This is all about asymmetric information. It's the persistent fear a liquidity provider has that you, the trader, know something they don't, so they widen the spread to protect themselves against toxic, highly informed flow. Now, all of these specific components, all of this complex market sentiment and risk calculation, it's all visualized in real time on the limit order book, or the LOB. The LOB is essentially the ultimate scoreboard of the market. It's constantly updating with price time priority, showing you exactly how many shares or contracts people are willing to buy or sell at various price levels. It is the digital venue where those bids and asks physically live and interact. All right, Section 4, Execution Slippage and Regret. We need to connect the mechanics of that limit order book to what actually happens when you pull the trigger on a fast-moving trade. Going back to our analogy for a second, settling in life is execution slippage in markets. Slippage is that painful, super frustrating difference between the exact price you expected to get when you clicked buy and the actual price the trade was executed at. When you submit an aggressive market order, you are demanding immediate execution. But if the market isn't liquid enough, your order will literally eat through the best available price and start consuming worse and worse prices just to fill your entire order. That post-trade dissatisfaction? Yeah, that's slippage. So when a really large market order comes in, it essentially sweeps the book. It consumes all the available liquidity at the current best price, which instantly creates a vacuum that drives the price up significantly before the entire trade is even finished executing. This dynamic explains precisely why massive institutional trades can't just be dumped onto the open market all at once. The resulting impact costs and the severe slippage would be absolutely devastating to their overall returns. Section 5. The role of market makers. So who exactly steps in to smooth out this entire chaotic process? Well, we need to introduce the institutional players who actively manage this spread and keep global markets flowing. A market maker is a firm, or sometimes a highly capitalized individual, that continuously quotes both buy and sell prices for a given asset. They are the ultimate financial matchmakers. They commit their own capital to hold an inventory of stocks or options just to ensure that whenever you want to buy or sell, there's someone on the other side of your trade. Their goal isn't necessarily to bet on the overall direction of the market, right? Their goal is simply to capture that tiny bid-ask spread over and over and over again on massive volumes of trades. Let's break down how this builds into a very specific step-by-step business model. Step 1. They post continuous two-sided quotes, providing constant liquidity to the limit order book. Step 2. They earn the spread on round-trip trades, buying at the bid and selling at the ask. But step 3, this is absolutely critical. They widen their quotes to manage their inventory risk. If a massive news event hits and suddenly everyone wants to sell, the market maker ends up dangerously long on a rapidly crashing asset. To protect themselves from the severe adverse selection in inventory risk, they instantly widen the spread. That makes it much more expensive for traders to interact with them until all that volatility finally subsides. And finally, Section 6, protecting your trades. Now that you understand the hidden mechanics of the spread, the order book, and those real dangers of slippage, how do you actually navigate this safely? The crucial point is knowing exactly when to use specific order types. Let's compare stop losses and limit orders. A stop loss is basically your emergency brake. It triggers an immediate market order to sell if the price drops to a certain level, capping your downside risk. But remember, because it triggers a market order, it is highly susceptible to severe slippage in a fast-crashing, illiquid market. Contrast that with a limit order, which is often brilliantly utilized as a take-profit order. A take-profit limit order specifies the absolute maximum price you will pay or the minimum you'll receive to lock in your gains. It avoids surprise slippage entirely. You firmly lock in your price, but the clear trade-off is that if the market doesn't hit your exact specified price, your orders simply won't execute at all. We've covered a tremendous amount of ground today, right? From the basic definitions of bids and asks, through the distinct components of market friction, all the way to the truly fascinating human psychology of the limit order book. I want to leave you with this final provocative thought. Every trade and every choice in life has an execution cost. Are you willing to pay the spread? Understanding market microstructure isn't just about staring at charts on a screen. It's about accurately calculating the true, hidden cost of your very next move. Thank you so much for joining me on this explainer. Keep learning, stay focused, and always trade smart.